Right on. You can see me and you can hear me, right, Vince?
Yes, sir.
Beautiful. All right. Well, we're going to go ahead and kick things off here. Welcome, everybody. Thank you so much for joining us. Vince, thank you for being here. I'm going to formally introduce you here in just a few minutes, but I'm Jake Alexander from Action Accounting. Welcome to our Build the Asset event. We're going to tell you how to turn your business into a more valuable, sellable, and profitable company. Like I said, I got Vince here. I'm going to introduce him formally in just a minute. In true accountant's fashion, I always like to start off with an agenda, just in value of everyone's time and respect of everyone's time. Make sure you know exactly what to expect. And most importantly, make sure you know how to get the most out of the event here too. So we're going to do an introduction. Going to introduce me and my host. At the end of the day, this event's not really about us. It's about the information that we want to bring to you. But I always think it's nice we're not two perfect strangers up here talking to you guys either. So just quick introduction about us, me and my host Vince here. Talk about a little bit of housekeeping and really just what to expect. And so the main section of our event today, we booked this for an hour. I want to spend a majority of the time talking with our expert here, Mr. Vince Perri, about how to build your asset, which is your business, right? How to bring more value and how to turn it into something that's profitable and most importantly, sellable. Because at the end of the day, majority of business owners, from what we've learned from experience, is that a majority of their retirement plan is the sale of their business. So we want to show you how to build that asset, how to get the most value out of it and turn it into a very profitable and sellable entity. My special guest is Vince Perri. He's a business broker. I'm going to formally introduce him here in just a sec. And then we always build time into the end of these for plenty of Q&A. So we book these events for an hour. It's usually 30, maybe 40 minutes of actual content that we have. And then we leave a lot of time at the end for Q&A. The reason is we want you to ask questions. We want you to get value out of it. And most importantly, we want you to interact too. So don't feel like you got to wait till the end to ask those questions. If they come up during the event, you can type them in there too. I want to make sure everyone knows how to do that is with the Q&A box at the bottom. You probably already noticed this is a little bit different than the normal version of Zoom where like everybody's pictures come up and you can come off and go off of mute and ask a question. We specifically don't do that in respect of everyone's time. If you ever been on a Zoom meeting where 3 or 4 people start talking at the same time, they can quickly go off the rails, and we don't want that to happen. So we do want to interact with you though. So everyone could do me a favor, just kind of quick tech check to make sure it works for everybody. At the bottom, there should be a Q&A box. If you don't see that, you might have to click those little 3 dots over there that say more and then click Q&A, but just type in like your first name and what city you're joining us from, just so I know everybody can actually use that and knows how to interact. The last thing I want is to be talking for 30, 45 minutes here and nobody knew how to interact with us the whole time. So if you could find that Q&A box, just type in there your first name and where you're joining us from, just so we know that that works there. And so perfect. We got a couple people. Dan from Tampa, Lee from England. I was just talking to you earlier this morning from Manchester, England. That's pretty cool. Vanessa from Blue Ridge, always a pleasure. Robin from Orange County. All right, cool. So that's working perfectly there too. Don't be shy. Type in that Q&A box throughout the course of the whole event if you have a question. I've got no problems interrupting Vince over here and making him answer that stuff on the spot. So we want to make sure you get value out of it. Quick introductions. If you're watching this, you probably already know who I am, but just to reiterate and just to make sure, I'm Jake Alexander from Action Accounting. We've been in business for 10 years. We have a team of 11 of us, and we have 4 main departments in our business. We have a bookkeeping department, which specializes in doing bookkeeping for business owners. We're reconciling transactions, categorizing things, and then providing them with financial reports on a regular basis. Most important thing about actually providing these reports to the owners of these businesses is actually spending a little bit of time diving into them and teaching them what they actually mean. We don't want to just be giving you a report for the sake of giving you a report. You want to actually start to understand, how is the income coming into my business? How are the expenses flowing out? So we really spend time diving in there, helping people understand those financials, because it is absolutely important. Second department is our tax preparation department, where we prepare and file tax returns for businesses themselves and the respective owners of those businesses. That's got to be done on a yearly basis, depending on what kind of business you're taxed as or what kind of entity you have. Those deadlines can shift between like March of the beginning of the year and October of the end of the year. Our third department is our tax planning department. That's where the real magic happens, is what I tell clients. That's a perfect example of what we're doing here today. We're being proactive. We're talking about things ahead of time. We're going to be talking about strategies to save you money on taxes and things that we can proactively put in place to pay the least amount of taxes as possible. Because at the end of the day, That is what is the most important. And our fourth department is our business advisory department, where we essentially do all three of those services. We take over the books for businesses, prepare their tax returns on a yearly basis, help them with tax strategies throughout the course of the year, then also help them do things like put KPIs in place and all sorts of other fancy stuff too. And so that's just a quick overview on me and our business. I always like to throw that out there. Now I want to introduce Vince. Vince, how are we doing this afternoon?
I'm doing amazing. How are you, Jake?
I'm good. I'm good. Vince, I love it because you've got, all these fancy letters behind your name and all this kind of stuff. But at the end of the day, you have like a real founder's perspective. I think you have like 16 years of building 6 and 7 figure businesses. You've been in the owner's shoes. You have all kinds of expertise. So this CEPA and CBI, that really means you just work the same, you speak the same language as like M&A attorneys and CPAs, which is incredible. You have a national network, so you got access to like this deep, deep pool of private equity groups and family offices that are actively seeking acquisitions, which is really cool. And then last, but I'd say most importantly, you have like a relentless mindset. Didn't you actually summit Mount Kilimanjaro? Is that true?
I did. I summited Mount Kilimanjaro. I've been to Everest Base Camp, and I was 1,500 feet away from the summit of Aconcagua in Argentina as well.
That is amazing. So I can
Yeah.
only imagine the mindset that it would take to accomplish stuff like that. That to me is the kind of guy you want in your corner for doing these kind of deals and everything like that too. So very, very cool. It's like you don't wait for perfect conditions, you just take action. And so welcome, Vince. Really glad to have you here. I want to jump right into it. So typically, I'm sure maybe some people will be disappointed, but not many of you. We don't have like a PowerPoint presentation or any fancy Excel spreadsheets to go through with you today. I really wanted to do more of just a Q&A to ask a lot of the questions that I have that we get from our clients on a regular basis, but really just get to know Vince and have him share his expertise with us. So, Vince, if you're cool with that, I'd like to jump right into it.
Let's rock and roll, man. Let's go.
But let's do it. If I can figure out how to turn this off here and get us going, we'll jump right in. So I'd like to start with like business value, kind of with that as a overarching umbrella, right? And if you're just joining us, I saw we had a few more people join in since my opening spiel there. Feel free to type your questions in the Q&A box. We want to hear from you. I'm going to list off a whole bunch of questions that I've got for Vince, but if you have questions that pertain to your personal situation, we'd love to get those answered for you too. So don't be shy. Use that Q&A box as much as possible throughout the course of this. But all right, talking about business value, what
Mike, you guys, did Jake freeze or did I freeze? Can anybody tell me on the chat? Was that me or Jake? Oh, okay, cool. Okay, cool. Thank you guys. I was like, what did I do? I thought it was me, but it was you.
Oh my gosh, are we still here?
It was
Is
like
everyone
right when
still
you're
here?
about to ask the first question, too.
How is that for like an epic buildup? No, the power just spiked at our office, but hopefully everything is back up and running and we'll keep it going. So sorry, I was just as surprised as probably you were and everybody else was by that. But if you can hear me, I'm assuming everyone else can too.
Yeah,
Sorry
we're
about
good
that.
now.
What makes a business valuable?
What makes a business valuable? Well, if we're talking about like, if I could be a little bit more holistic, I like on the questions, I'd like for people to I want to ask a question to the people in the chat right now. How much do you think your business's worth is to your net worth? 60%, 70%, 80%, or 90%? I'd like to see if we can get some answers. What do you think of your overall net worth? how much is it of your actual business? Remember, you have real estate, you've got savings accounts, you've got stocks, you've got retirement funds. How much of your net worth is in your business? 60%, 70%, 80%, or 90%? I'd like to see if we get a couple guesses.
Yeah, that's
50,
interesting. I've never thought of that.
60,
So we got, can you
60.
see it too? Oh,
Yep, I can see it. 60. I had a feeling that would be the answer. So the answer is, and I got it right, it is 80%. Now, this was done by the Exit Planning Institute. This is an actual owner readiness survey that was done. I think it was back in 2023. 80% of your net worth is hiding in your business. So if you add up your entire net worth right now, you could tack on to the actual business valuation. So to answer your question a little bit more holistically, it matters a lot. It matters 80% of your overall net worth of how much your business is actually worth. Now, what increases your value, what decreases your value? Overall, it boils down to profit. The more profitable you have, the more profit you have in your business, cash is king. The more cash you have in your business, the higher your business is going to be worth. After that, you've got intangibles that ultimately determine the multiple as well.
that's great. I love that. Could you give us some examples? Like, what are things that people who own the business think add value, but at the end of the day, the buyers are like, it doesn't really make a difference to us, you know?
I mean, I know we were talking about financials. Having clean financials is very, very important. So someone like you coming in and making sure those financials are clean is very, very important because it does bring up red flags if they are not and if they are a mess. Also, what brings up red flags, which I'm sure you deal with on a daily basis, Jake, is a ton of personal expenses. Like, we understand that purchase at Amazon was partially or could have been used for your business, but maybe it was and maybe it wasn't. The more of these personal expenses that, as a business broker, when I'm evaluating the business, I now need to add back because it's not going to go with the new owner, it also kind of raises some red flags as well. So try to keep your personal expenses separate from your business expenses. Even if they mix a little bit, I would say in that 3-year plan before you actually decide to exit, maybe separate them.
It's interesting you say that because we do quite often where they need help with the ad backs and that sort of stuff. And kind of at the end of the day, there's nothing wrong with maybe running that personal expense through the business, but also do you see that makes the buyers question, well, if they're running this part this way, how are they running other parts of the business as well, you know?
Yes and no. The problem with so many ad backs is then they just start to question it. Because obviously the more you add back, it increases the valuation of the business. So as a buyer, if as a broker, I'm putting all of these ad backs that you told me to put in because it's a personal expense and we want to increase the valuation, it just brings up red flags. And if we're trying to increase the valuation by putting all these ad backs, what else are we trying to do potentially behind the scenes in the valuation?
Got it. And you said 3 years. Is that typical, like a typical ramp up period of, hey, we want to sell within 3, 5 years, whatever. These last 3 years, we want to have the cleanest financials as humanly possible, right?
Yep, because that's usually what they are requesting. Any kind of buyer, private equity, or anything like that. They're looking for the last 3 to 5 years of your financials to see the trend, to see what's going on, to see how you've reported everything. So, yeah, we're looking at usually anywhere from 3 to 5 years. And then also in the whole preparation phase, besides cleaning your financials, you've got 3 years to really, what I like to say, make the ugly baby look pretty. It's hard to do it in a short amount of time. It's much easier to do it. So removing owner dependency, creating some kind of recurring revenue, diversifying your customer base a little bit, improving your social proof and your Google reviews and your website and your branding. 3 years gives you a nice time to really make the ugly baby look pretty.
That's awesome. What's one of the first thing buyers look at when they're evaluating a business?
It's probably, besides the financials, we're looking at owner dependency is huge. I could talk all
Okay.
day about I could talk all day about the intangibles, right? Like your social proof and your customer base and your recurring revenue or your culture in your business and your systems and operations. All that stuff is very important as well. But nobody wants to buy a job. Everybody wants to make sure that you have someone in place. So in those 3 years, guys, what you can do there is ultimately, uh, what do I want to say? Like bring somebody up from within, give them what's the word I'm looking for, Jake? Like like an improvement. What is the word I'm looking? Elevate them.
Like a raise in responsibilities,
Yeah, not a raise, but like put them up in the next level. I can't think of the word. I'm just going blank.
like a
Or
pedestal.
yeah, or hire promote. Thank you, Vanessa. Promote from within, or you could hire somebody from outside.
Okay. And you just mentioned it, but like clean financials, this is going to do nothing but just increase the buyer confidence, right?
Clean financials and increase the buyer confidence and just clarity from everything. Clear systems and operations that makes it transferable. Ultimately, what we're talking about here is the transferability of a company. Take a look at the 30,000-foot view of your company now. If I were to give that company, if you were to just give that company to me tomorrow, based on what you've given me, would I be able to take it and run with it? Or would I be just stuck and need you hanging around for a year or 2 years to help me actually understand how the business is run? If it's the second option, then chances are a lot of that stuff is in your head, and whatever's in your head needs to be on paper and trained to all of your staff.
So this is like SOPs, systems, processes, all that really fun stuff that as business owners we all love doing so much. Wink, wink, right? Not really, but you got to take the time and get all that stuff documented and out on paper, right?
We implement systems, we implement processes, we implement workflows, and then we create playbooks. Playbooks I love. I just love using the term playbook. I don't know, it's just cool. But yeah, we have playbooks. And then for the sales team, we've got scripts, we've got marketing strategy, we have the entire strategy of organic outreach, how the customer journey goes. And then from there, every single employee has to follow that process to a T. And guess what? Any kind of process that is not followed, well, they need to basically create a memo and say, well, we're doing it this way now. We have a meeting about that, and then we implement the change if it's necessary.
That's awesome. I not to change the subject or to turn it back to us, but I everything you just said, bro, majority of what you just said just makes me think of like when I talk to business owners about bookkeeping. It's kind of like this instant, like that's the last thing somebody wants is like proper bookkeeping, right? But it's not about the bookkeeping. It's about the report that's giving you the information that's going to tell you everything you need to grow and scale the company. It's like it's not just about doing the books or getting the P&L. It's looking at it, having those conversations and analyzing it so you can turn your business into a real business, right?
It's also we offer a 90-day sprint, right? For cost. If you really want to make that, I keep saying ugly baby, but it's just a great term. If you really want to make the ugly baby look pretty and you want to make that ugly baby look pretty fast, we offer a 90-day sprint. And part of that 90 days is we're doing a pre-due diligence. We're doing a pre-quality of earnings. So we are getting an expert accountant, bookkeeper, we're diving into the books and we're uncovering everything and fixing everything that we can before we even put it to market.
That's incredible. I love that. I want to hear a little bit more about that. But I want to kind of switch gears and talk about maybe this will be an interesting topic here is like some mistakes, So what's like the biggest mistake you've seen reduce a company's value?
Well, I mean, for one, is every business owner thinks that their business is worth more than what it is. The worst thing that happens, and it does happen, is you put your business to market and it ends up not selling. And then the biggest mistake is just every business for the most part is too owner dependent. Mine as well. I'm gonna be upfront. All right. I'll tell you
We're
the
in the
truth because I
trust
obviously
tree
run.
here. We're not picking on anybody, right?
Where this is a nice little private, little webinar here. I'm guilty as well. I'm guilty as well. It's if I were to sell my exit advising business tomorrow, it's too owner dependent, right? I'm still building it. We're still getting there, and every move I make is towards removing myself. But every business is a little too owner dependent, and we need to get better at hiring and making sure we're putting the right people in place. But that's, I know that's tough. That's a tough juggle as well.
Yeah, no, that totally makes sense. And so it sounds like you've had that conversation with people that their business wasn't worth what they expected before.
So the answer to your question is putting your business up for sale too soon.
Got it. That would be the biggest mistake because the last thing you want to do, put it up for sale, it doesn't sell. Then when we go to re-engage or retry later, you got to have those whole conversations. Similar to real estate, I would assume, right? So if a real estate agent, quotes the wrong pricing or whatever it was, that house sits on the market for 10, 12 months, it's going to be a lot tougher down the road to resell that. Same with the business is what you're saying.
Yeah, and that's the issue that you have working with only business brokers, and I'm a business broker, is business brokers tend to just want to sign a listing agreement, roll the dice, throw it on biz buy sell, and let's sell it. And then what happens is, guilty again, it happened in the beginning of my career, is you put a business up for sale and you start to realize the holes because all the buyers start asking all these questions that you didn't ask from the get-go.
Oh,
You didn't prepare, and now your business is getting more and more unsellable. And you've already got a listing agreement signed. It's already up for market, and you want to do that stuff before.
got it. What would you say? What's the hardest conversation you've ever had to have with a business owner?
The buyers are backing out. I hate
Ooh,
that conversation.
that can't be fun,
Buyer,
right?
no, because you spend months getting to the closing table and then they decide to back out because it's not worth what they offered and what they hoped it was worth, and they've officially now backed out and we have to start from scratch and we have to start over again.
Gotcha. So if somebody wants to sell in 5 years, when should they start this whole process? When should they start preparing?
Well, to answer that question, I would always say from the beginning, you should always be preparing your business for exit. I think your business should be year-round exit ready. So we do owner dependency scores. We do recurring revenue scores. We check to see if there's any kind of subscription model. From the owner dependency scores, we do valuations on a yearly basis. We do a value clarity report, which uncovers all the gaps and all the holes and all the questions that buyers are going to be asking. And I always suggest that you run one of my reports at the very least once a year, just to get the updated valuation, updated gaps. Did you fill all the gaps from the year before? And then just making sure that, because what you have now a lot, Jake, is you've got a lot of people who want to invest in small business. So you're going to get several different kinds of buyers. You're either going to get the person who wants to buy your business outright. You're going to get the person who just wants to invest in your business. Maybe you're going to get the person that wants to buy the majority of the business. And then you've got the private equity side of it. And you never know when these people are going to come knocking. You want to make sure that you're exit ready so that you can get the highest valuation for your business.
I love that. Just to highlight for a minute, one of the reasons I wanted to have you on, one of the main reasons is I've seen one of those reports is actually from a mutual client we're working with, and he told me, hired a business broker. He's done evaluation and stuff, which we've seen those many times before. But this report that you provide was actually really, really cool. It gave him a ton of information, and it really showed him the opportunities of what he could do to put himself in a better situation. And this, I want to say too, this client had just bought the business. Like they're not considering selling in probably 10 or 20 years or whatever it was, but they wanted to be super proactive. And so I found a lot of value in that report too. So just a quick shout out there. We do have a question from Lee Dempsey. He says, I'm running my US company remotely. So he lives overseas. He said he's done this work for 11 years. He's considering moving to America to work within the company. Should he consider this option as it could potentially affect his value?
Oh, no, I don't think so. I mean, it depends on what the reasonings are of you wanting to move to the US. I mean, is it because of the business only, or is it maybe financial decision? Maybe it's a family decision. I wouldn't allow that to affect because there's thousands of US run businesses where the owner lives in the US as well. So I wouldn't say because you could, and there's thousands of businesses as well that are completely virtual and remote where the owner is still too dependent on the business. So I don't think that would make a difference, Lee.
Okay,
It's more
nice.
of a personal,
We got
that's
another
more of a
one.
personal decision.
Based on, do you want to live here? Do you want to live
Yeah.
overseas?
Yeah.
If anything, I could, not to get too off track, but I could say the fact that he lives out of the country almost helps his, what you call owner dependency score, right? Like the owner doesn't actually live here in the States. He's not actually in the building on a daily basis. So that would potentially help or not so
It's
much.
not even, it's not one of my questions on my owner dependency score or whether they live in the same place that the business is. So I guess technically it wouldn't make a difference. Because I ask things like, does every decision run through you? If you were to not talk to anybody in your company for 30 days, can the business still run? Does the
Uh,
business make more money while you are not working in the business? There's a laundry list of questions, but none of them are if they live in the same country. I mean, I could
Not
add
where you're
that, but
physically located, more your
right.
impact on the business is what it sounds like.
Exactly.
Very cool. All right, great questions. Keep it coming. Charbel, how you doing, buddy? Long time no see. Thanks for joining us. Charbel said, with the new QSBS changes, how has the business sale prep changed in terms of entity structure? Are you seeing a lot of C corps now?
Mostly LLCs is what we see for the most part. That's kind of like what the common kinds of businesses that we get for sale, to be honest with you.
Okay, nice. Then another one, Joanne says, if the business has an SBA loan attached to it, is this helpful or a hindrance to sale?
No, it doesn't make a difference. Typically, if there's an SBO loan attached, well, the loan rides with you, so you would ultimately have to pay that off once selling the business. That does not go to the new buyer.
Yeah, my understanding with that is the new buyers aren't necessarily concerned with it because they're going to pick that right out of the balance sheet and say, hey, we're not taking that out.
Right.
You just need to basically be able to absorb that with your
Yep.
monthly payments or the proceeds from your sale. Make sure you know you need to pay it off, right?
Exactly. When Joanne is doing the math on the valuation and doing the math maybe with you, Jake, on how much she's going to get affected in taxes,
Taxes. Yep.
she's going to have to also account for paying off the loan.
Okay. Awesome. This is great. And I saw we had a few more people join too. Just a reminder, use that Q&A box. Thank you for those people who are putting questions in there. But if anybody else has joined, make sure if you do have any questions for Vince, you pop them in that Q&A box. We'll answer those as they come up. This is great. Thank you so much, Vince. I got a ton more questions here, so we'll keep going into this. I kind of want to switch gears and talk about like what actually makes the business more profitable. So like could a business actually grow while it's becoming less valuable? Like if revenue's going up, could that change the actual value of the business or?
Yes, of course. I have a perfect example right now. We did a trailing 12 months of the business when we put it up for sale just 3.5 months ago. We did a trailing 12 months SDE, and now we did a new trailing 12 months SDE, well, over the next 3 months. So we added 3 months and we deducted 3 really good months on the front end, and the SDE actually dropped about $100,000. So, yes, because if you're having to spend now, I could argue those because we did have some one-time expenses that wouldn't normally occur. But like I said, your SDE or your EBIT is going to be strictly reliant first and foremost on your profitability. So if you are not profitable, then it will ultimately lower the value of your business. I don't know. What was the question again? Just so I get it back.
So if business is growing, can it actually becoming less valuable? So like if revenue's going up, is there ever a reason that would cause it to go down in value?
Technically, yes. If you're reinvesting a lot of the money back into the company, which means you're generating more overall gross revenue, but you're profiting less ultimately from that, then technically, yes, you could actually be decreasing the value of your business while increasing overall revenue. But the beauty about this is there is also a way that you could increase the value of your business by maintaining the same revenue, not only by increasing profit, but by the intangibles, really dialing in those systems and processes and workflows and playbooks, elevating people, promoting people into leadership positions so that you are no longer as owner dependent. If you could implement, guys, a subscription model. My team is so tired of me talking about this, but it is huge. I don't care what kind of business you run, you can create a subscription model. Talk to AI, talk to ChatGPT, and get some ideas. But I would slowly start to implement specifically for your current customers. Anyone that has bought from you once are more likely, usually 70%, to buy from you again. So implement some kind of, whether low price, mid price, per month, per quarter, per 6 months, per year, recurring revenue subscription that you could automatically make that money automatically.
And so that's with like any kind of business.
Any kind.
Are
It's part of
you're
our 90-day
saying
sprint. It's part of our 90-day sprint as well, and then definitely part of the three year advising that we do. For sure that the 90 days is a little bit tougher, but if we could at least have an idea of what it'll look like, we implement that. But if you've got 3 years, I would start something now. I had a quick story. I had a client, pressure washing business. I informed him to do that. And by the time we got to the closing table, he had already, of his 150 solar clients, he had about 35 on a subscription model, and the buyer was very happy about that.
Okay, so instead of him going and cleaning the driveway and the pool cage, once a year or on an as needed basis, they're now on like a
Mhm.
monthly subscription, you're saying, or?
Six months, every 6 months.
Okay, awesome.
Yep,
So it
and for
doesn't even
being
have to
part of
be
the for being it's every 6 months, and for being part of the program, they get a 10% discount. And then the beauty about being part of a program is anything else that you add to your business, any kind of product or service that you add, you shoot that out to your special members, and they are going to typically buy.
I love that. I love that. So how important is profitability compared to revenue?
What is it? Profit? No, what does it say? Revenue is profit is sanity, revenue is vanity. Yeah, revenue is vanity, profit is sanity.
Okay.
I know, Jake. I know you're an accountant. We're trying to save on taxes, but if I could if I could advise you a little bit on this, is those 3 years, let's show some profit. And let's cut down on those ad backs is probably the most important, because I don't know the exact number, so I'm not ready for that. But typically the amount of money that you save on taxes compared to the valuation and the sale price that you could put on your business, there's an equation for it. I just don't have it in front of me. It's much more money that you make on the sale than you would saving on taxes.
Oh yeah, I agree with you too. I could give you numerous examples of where we see, $5 million businesses that are breaking even or even losing a little bit of money because there's so much subjective activity in there compared to like a $1 million business that's pumping out $350,000 a year in profit. The one with the profit's going to be more advantageous, more tempting for these buyers, I would assume, right?
The other thing I would say, Jake, and I don't know where you stand on this, is for me, as always have been a small business owner, and my business has always been the breadwinner. Like it's what makes me money. Aren't there other ways that you could save on tax? Like if your business, let's say if all these people here they own their own business, and how they make their salary and their main money comes from their business, wouldn't you agree that tax savings should be placed more on an investment or a second business or a real estate property or something else than all on your business? Like buying that random truck to save some money on taxes that could hurt your salary maybe the next year. That's no fun.
Yep. We look for kind of like you said earlier, holistic opportunities, right? So if you need a new truck and you need one that big and you want to get the big deduction in 1 year, then great, go ahead and do it. But no, it's not free. You're only saving that percentage of whatever tax bracket you fall in on the actual deduction itself. And so, yeah, we look at that. We're big fans of like short-term rental properties as investments, retirement plan
Right.
contributions, all sort of other what I was just talking to a client before this, and it's funny. I mentioned, I said, what we try to do is keep it where you're taking home the same amount of money, you're actually showing the same amount of profit, but a lot more of that money is going in your pocket than going to the IRS. And so, to me, that's the ultimate goal.
I got you.
Nice. Another question from Charbel. He says, "Are retirement plan contributions from the business in the defined benefit and cash balance plans added back?"
Retirement plan contributions are definitely added back because that's for you. That's personal use. Yes, it's deducted on the business, but yes, that is added back.
So that's kind of a perfect example of what we were just talking about. Instead of spending 100,000 on a marketing campaign, let's put 100,000 in
Exactly.
this cash balance plan or this defined benefit plan, and that's an easy add back compared to explaining your marketing campaign that they might not need next year or something like that. So
Exactly.
yeah, great question. Another one from Robin here. Is there a tax strategy to minimize tax liability on capital gains generated from selling the business? Ooh, I could hop in on this one
Yeah,
there.
help me with that one.
Yeah. So the big one there is just knowing your basis going into it. It's sort of a convoluted complicated way that we come to that number, but the easiest way to explain it is if you own a business, you should have some sort of basis calculation over the years, is essentially the amount of money that you've paid taxes on already, but not taken it out of there. So in certain situations, the basis can be very advantageous for you. In other situations, it may or may not make a big difference. To me, that's the biggest one, is understanding that. And then one of the strategies we directly recommend for people who are selling their businesses and have large capital gains is called leverage donations. Um, I can take just a minute to explain it, not to take a ton of time away from you here, Vince, but everyone's pretty familiar with a charitable donation, where if you donate an amount of money to a charity, to your church, or social organization, or whatever it is, you can take that amount that you donate as a charitable deduction. Then at the end of the year, whatever tax bracket you fall in, you're essentially getting that percentage of a deduction off of that amount. So if you donate $100,000 and you fell in the 37% tax bracket, you essentially get a $37,000 tax deduction. A lot of people are familiar with that. There's also a different strategy called a leverage donation, where there's organizations out there that are set up with a certain way and with the IRS, where you donate money to their cause or product or service at the fair market value of what it costs them to build their product or service, but you actually get credit back for what they sell it to the public for. And so you donate at the cost of what it costs them to create it, but you get credit back at the fair market value of what they sell it to. And so those right there can be perfect for capital gain situation when you're selling your business. So Vince, what separates great operators from average ones?
Oh, leadership. Leadership. I mean, ultimately that's what it's all about. And to me, leadership is all about making sure that the people around you understand what the end in mind actually looks like. Making sure there's three, I always say three things in leadership is making sure they understand what the end in mind looks like, what the big picture is, making sure that you're keeping track of metrics. Metrics are so important. You cannot keep track of what you don't keep track of. And the last thing is coaching. You have to be able to coach and teach, well, whenever, there's teach the plan, but teach the ins and outs and the X's and O's. Ultimately, I think that's what leadership, that's what being a good operator is ultimately about.
Okay, great. What KPIs should every owner be tracking?
Yesterday, I came up with a good one, and I'm calling it enterprise value. Oh, I forgot the name of it. One of the KPIs I think I do believe that you should be keeping track of the valuation of your business on a yearly basis and keeping track of what your valuation was the year before. Keep track of your EBITDA, your SDE, and what multiple are you receiving, or what multiple range are you receiving based on sort of the way your business runs. I think you should do that on a yearly basis and you should keep track of it. I think that's very important. As far as KPIs financially, because I'm sure that's where the question is really coming from, is what financial KPIs to look after is really just your overall gross profitability. What's your gross profit margin? Especially if you are, if you're consulting, it's a little bit different. You don't have what's the word I'm looking for? Again, I'm blank, but the
Moving
gross profit.
pieces per se.
Yeah, like for a product, it's easy, right? We want to know exactly what is the cost of the product and what are you netting as a result of the cost of that product to put into your operations and everything else like that. So your gross profit margin is something you should definitely keep track of, which I believe should be this. I don't like to throw numbers out there, but I believe you should be around 60, 70, 80% of gross profit margin. And then your net profit margin, I definitely don't want you under 10, and I'd prefer you around 15 to 20%.
Very nice. No, I love it. We got some follow-up questions from questions before. So this is from Charbel. His original question was, are the retirement plan contributions added back? He said yes. He said, what about the ones towards the employees from the advance plans? So
Not
like
for the
I'm
employees.
assuming the profit sharing percentage to the employees.
Any retirement plans or anything like that, anything regarding the employees, so long as they're all staying on, yeah, no, none of that stuff is added back. It's only in relation to the actual owner.
Because that would be considered compensation for the
Hmm.
employees. More than likely, the employees are staying on board. So
Hmm.
you're not going to not pay them these bonuses going forward. That probably wouldn't go over very well.
That would not go over very well. That's
You probably
definitely part
wouldn't
of the
recommend that, I would assume. Yeah.
now, and that's a conversation we have with the business owner that's selling too, right? Like, what are his goals or her goals? What's most important to them? And you'll be surprised. The answer could be the employees, the answer could be profitability on the sale, the answer could be a lot of things, but a lot of times it is the employee, and they want to make sure that their employees are taken care of, and retirement plans are one of those things.
Nice. Very nice. Then another follow-up said, what about a 453 trust, deferred trust? Says Robin was asking about tax strategy. So 453 is a deferred sales trust, Robin. That could be a good potential strategy. However, there's quite a bit of complication that comes with setting that up. And in my opinion, the key word there is deferred. So it's not going away. It's just deferring those capital gains on there too. So if you wanted to have more of like a one-on-one conversation about that, I'd be happy to. In my opinion, if you're looking for a direct mitigation of those taxes in the year that you sell, the leverage donation opportunities, which we have a number of vendors we work with on those, is the most impactful, and that would be what I would recommend. So let's keep going here. So we talked about KPIs, we talked about all sorts of other stuff. Let's talk about planning for the future a little bit. So how, I think you answered this, but how early should owners begin exit planning? This is as soon as possible, right?
Soon as possible. We do a personal readiness check, we do a financial readiness check, and we do an overall exit readiness check. We give scores for that. That comes with the report that we provide. And we ask you questions like what's life after retirement look like? And it's good to have a plan for that. If your answer, which is very typical, uh, hang out on the beach, go golfing, or travel, because those are the three most common answers that I get, then you don't really have an exit plan because you, Jake, myself, and probably everybody in this webinar right now, we're all entrepreneurs, which means we probably suffer from ADHD. We cannot sit still for 1 second, and we have ideas coming through our brain every 5 minutes. And once you decide to retire, well, that you no longer have that. So there needs to be some kind of purpose that continues. Usually it's philanthropic that you could think of, something that you could give back to, or it'll be some kind of consulting role. Or your choice may be, your exit plan from your business may be to stay on for a couple bites of the apple is what it's called. Maybe you don't want to sell 100%, or maybe you want to sell to your kids and you want to stay on as a consultant for your kids, or you sell it to your employees and you want to stay on to help them out with the transition. So it's a lot of different things. We get it very in depth with life after exit, and it
I
should
love
start immediately. You should start thinking about it now.
I love that. Not to get too off track, but you said like another bite at the apple. My favorite sort of structure that I've seen is, smaller business sells to a similar business in the same industry or vertical, but bigger, right? Owner takes some chips off the table, if you will, in the original transaction, but then stays on as an employee or a contractor with a much smaller percentage of that bigger entity, with the goal of that one then selling in another 5 or 10 years. To me, that seems like such a cool strategy to be a part of,
Private equity is the best for that because their main goal is to work the business for a set amount of time and
to
then sell
grow
it
it
for
and
more
sell
than
it,
what they
right?
bought it for.
Love that. Love that. Chris Sims. Chris, how you doing, man? He's got a question for us. He says this company's heavy on 1099 independent contractors. So if he's seeking to sell down the road, would it be wise to eventually get these as W-2 employees rather than contractors? Do potential buyers typically just want W-2s, or does it make a difference? Great question.
Great question. So I could answer that a couple of ways. So one of the things that we help business owners with, in my opinion, what's most important besides lead flow, you should always have a way that you could create leads by turning something on or doing a particular strategy. Lead flow is one, and then the other thing is a pool of people that you could hire from. That's another thing that we help with. So in regards to the 1099, I would say, Chris, making sure number one, whatever it is that these people do, these 1099s, that process needs to be down and it's got to be tight and it's got to be the same way every single time. Training as well needs to be implemented to all of these 1099s. So onboarding training, quarterly training, making sure you're just testing to see exactly how they're doing and you're doing reviews so that if you bring somebody else on, that job's going to continue and it's going to continue the way it's supposed to. And then besides that, the hiring process needs to be the same all the time as well. And then the last thing is having a pool that you could always go to. And it's very difficult if you're in home services to find this. It's something that we're working on with some home service companies, but having a pool of good, talented people that you could just go to whenever you want to replace that person. Because if you have all that built out, if Jake comes and buys your company, he could just follow that exact process and never have a problem.
So whether or not they're W-2 or 1099 doesn't sound like a big issue. It's
Mm-mm.
where do you find them? How do you train them? How do you replace them? Essentially, more like what's the process behind. Got it. That's interesting.
Making sure it's repeatable. Because
Okay.
W-2, I get it. Again, I'm a small business owner, so W-2 is going to cost them. Maybe the 1099s, it could be commission only, so that's like great, right? So the W-2 employees, it could cost a little bit more. I may be giving you an answer that another exit advisor might answer differently. Maybe they say that W-2s are more important, and obviously he asked the question, and we can see why they would be because they'd be part of that, internal culture. But if you set the 1099s up correctly, where it's a rinse and repeat process, just in case anything happens, you're good to go.
Love that. Love that. And if anyone else has any other questions, pop them down there. We got about 10 more minutes with Vince here. So I got a couple more questions, but if anyone else has some other ones, pop those in the Q&A. We'll make sure we answer them. Why should you talked about it a little bit earlier, but kind of remind us. So if I'm not even considering selling my business anytime soon, why should I be concerned with the valuation of it?
I mean, I always say exit strategy is good business strategy. Okay. So what does that mean? That means you're profitable. You're constantly looking at your profitability. You're constantly looking at your cash flow. You're constantly trying to increase that so that you could reinvest into your company as well. But then you're also looking at the intangibles. And the intangibles are you're constantly making sure that it's not too owner dependent. You're constantly implementing systems and operations. You're constantly training your team. You're constantly creating that lead generation. You're constantly creating that hiring pool. You're constantly creating and promoting people up. Right. So all of the same things that I help business owners implement within 90 days or even within 3 years is just overall good business strategy. And the way we do it is if I'm working with somebody for say 3 years, believe it or not, every quarter we have a meeting and the question is asked, okay, you're here now. Do you want to do you want to sell or do you want to keep growing? And then what ends up happening is like, wait a minute, we're building a well-oiled machine here, and we don't want to sell anymore.
Maybe I don't want to sell it. Maybe I'll just hang out and not have to work 80 hours a week and earn all this new profit that's coming from the business, right?
Well, it's and also do the things that light you up. I learned that from Dan Sullivan, a strategic coach, is you don't you audit, you transfer, you fill, right? So that's the thing, three things that we do. So a business owner needs to audit their calendar and all of their to-dos. They need to transfer it to somebody else, and then they need to fill it with something else, okay? Everybody always gets the fill part confused. It's like, "Oh, wait, so I'm not doing anything. I'm bored now." No, no, no. Now it's when you really can drive the company forward.
I love that. You kind of mentioned it earlier too of, this dream of sitting on the beach and, having a drink or hanging out with your family or whatever. And that stuff is amazing. But to go from the excitement of the day to day to running a business to just having nothing on your calendar all day long, I can honestly say that would be pretty challenging.
It'd be terrible.
So another question. This is, I think, follow up. So it says, how do you find buyers to buy the businesses? Auction question mark, cold calling buyers, or some industry standard platforms. So I guess where do you find the buyers if we're going to sell a business?
All of the above. We have a buyer pool. So anybody here, if you guys want to message me and you want to become part of our buyer pool, if you're looking for a business, we have two ways of our buyer list. We have the passive buyer and we have the aggressive buyer. So the aggressive buyer will sign a retainer with us, and we actively look for a business and we do cold calling. So if Jake's looking for another accounting firm and you've got the revenue that you want to acquire, like we know exactly the location, this and that, we'll cold call. We'll scrape with AI. We'll find contact and we'll say, hey, we've got somebody who's interested in buying your business. Do you want to sell? You know, so that's the active buyer, but that's on a retainer. While the passive buyer, that's just we send them a weekly update of businesses for sale. But then we reach out to our buyer list. They get first dibs, so they get the teaser with a blank NDA, and then we'll send them the SIM if they want it. And then again, it depends on the business owner and what they want, but typically we'll post it on Biz by Sell. I'm super prevalent in social media. You could find me at Vince Perri Official on Instagram, Facebook, LinkedIn, and YouTube. We will promote the business across social media, throw some ads if that's what the seller wants, and Business Brokers of Florida, we posted on there as well.
Nice. So you're kind of this all over approach. Not all over, it's very
Yeah,
concentrated, but you have a multi-pronged approach is what it sounds like.
exactly.
Amazing. Chris is asking, do you find an advantage of trying to sell to a PE group versus an individual or small team looking to get into business? And then there's a follow-up, but if you want to tackle that part first.
PE typically, although they've dropped a lot over the last couple of years, PE typically is looking at a 3, 4, $5 million EBITDA. So if you take 3 million, then you put the multiple behind that, you're looking at a business that's probably valued at over $10 million. Where anything less than that, you're typically could be a roll up. So I gave Jake as a great example. If Jake is very common in accounting, where somebody will own several accounting firms and then they go purchase another accounting firm, that Jake probably, you don't have to answer Jake, but Jake probably doesn't care. Depends on what he's looking at. He just wants the book of business. So do I find an advantage of trying to sell? It depends on what your goals are, Chris. Ultimately, it depends on what your goals are.
So not really an advantage to selling to one or the other. I think it's more what's the EBITDA of your business, and that's going to attract different types of buyers. It's kind of what I'm hearing there.
Yeah, but if Chris wants to stay on and Jake wants that too, because he doesn't want to deal with it or he doesn't have the person to implement it, then that's a good fit. If Chris doesn't, if Chris wants to stay on and Jake, you've got the whole team ready to rock and roll and you're just going to implement your people so that you could save on those expenses that that particular company had, well, then that's not going to fit because
Got it.
Jake might be getting rid of the employees.
So it really depends on like what's your goal because he says here he asks here too like are there advantages based on sale price, protecting other members with the team, and the ease of transactions. I think it really depends on sort of your overall like what's your goal through this, but including yourself, your existing team, all of that sort of stuff.
All part of our process, making sure my goal is every time I bring a new company on, whether for brokering, advising, my 90-day sprint, the 3 year, whatever it is, I'm always adding questions because there's always more questions to ask. And the number one though, since the beginning is we want to make sure that we are following the goals of the business owner. That's what's most important. And that could vary tremendously.
Got it. This has been awesome, Vince. I can't thank you enough. I'm learning stuff. I'm taking notes over here. We got about 5 more minutes before we're gonna wrap this one up. We still got people on. If anyone has any other questions, type them in that Q&A box. We'll make sure Vince answers them. If nobody else asks any questions, I always take that as a compliment. It's like, man, we covered everything so well that nobody could actually have any possible questions left for us. So we got a few more minutes. If you got any questions, pop them in there. While we're waiting for that, Vince, real quick, somewhat of a lightning round. Like, what's the biggest red flag in your opinion when somebody goes to sell their business?
Messy financials.
They have like the shoebox, and we know nobody here would do that, right? If they have
Right.
the three different Excel sheets that don't quite add up over the years. So when you say, what's the opposite of messy? Is that being in QuickBooks or some sort of like financial platform? They got to use a software, it sounds like, right?
Oh God, please. Yes, if you're not using QuickBooks Online, I mean, that's the easiest thing that you could start with. I advise you start with a bookkeeper. Once you surpass maybe 1 million or maybe a little bit more, maybe you can start thinking about a controller. And then,
More of an
from there,
in-house person.
yeah, and then you get to the, 5, 10 million gross revenue. Maybe now you start the CF, what is it, the chief financial officer, CFO or something like that. That's the route that I think you should take. But start yourself with your administrator with QuickBooks Online. It's not hard, and then go to a bookkeeper.
Nice. What's the biggest green flag? What's the biggest positive? So if somebody going into this process,
Clean financials. Um,
that's an easy one, right?
Biggest green flag. Well, what do you mean? Biggest green flag, like for a buyer or for the seller ready to sell, or what do you
I'd say
think?
for the seller, right? Like, what's the biggest thing they could have going for them that they maybe don't even realize yet?
A well-oiled machine. If it's still a little owner dependent, but you've got systems and processes in place and people are following them. You've got a nice culture. You've got good leadership. You've got maybe not a management team, but you have people in leadership positions that and they're good at what they do. One of the most important things you can do is invest in your people. And if you don't have the money to invest in your people, then you need to invest your time and your knowledge in people. Do not hold back. I think the best thing that I ever did as a young leader was the worst thing I did was hold stuff back because I was worried that they would get better. And then I had an awakening moment, a realization that that's the opposite. And you need to teach them and you should be helping them grow personally and professionally. And if that means they go on to bigger and better things, then you know what? You're the reason for their growth and development. And that's something that you should be proud of.
I love that. Kind of on that same vein, if you will, but you were talking about ad backs and kind of things that we could explain. This was a one-time investment. It wouldn't necessarily carry over to next year. Would like hiring a consultant or hiring somebody like yourself to help people build those systems and processes, that would be like an investment that they could justify, I would assume, right?
Yeah, that would be an ad back.
Very nice. If anybody has
Yeah,
any
the big
questions,
ones, we add back the big ones, like big stuff like that. But when it comes to, yeah, obviously an exit advisor, 90-day sprint, or 1 year of getting your business ready, that's not something that the new owner is going to have to worry about. You would definitely add that back. But like the meals and entertainment and like the little
my
things,
BMW payment.
I honestly usually leave those out anyway. I don't add those back because, like I said, when a buyer is looking at the little finicky things that the business broker is adding back, it's like, what are we doing? You know?
Got it. If anybody has any last minute questions, type those in. We'll answer them. Vince, how does everyone get a hold of you if they want to have a conversation?
So everything is Vince Perri. I bought the website as well, vinceperri.com, Perry with an I. You can find my information online there. You can find me on Instagram, Facebook, and LinkedIn, which is Vince Perri Official. And then we just launched a new YouTube channel. I'd love for you guys to subscribe. It's called All Business with Vince Perri. It should come up there. I do have two YouTube channels. One's about Public Adjuster. That was one I did for a long time. We still update it every once in a while, but the new channel where we post everything is All Business with Vince Perri. And then for your audience, Jake, so we do a value clarity report. Okay, that's an actual report that we charge money for. If you guys are interested in that, you could reach out to me. But I do have a free version of it, where basically it's a guide step by step on how I literally achieve and complete the report for someone else. It's so that you could do it yourself. So it's like a step-by-step guide on how I do the value clarity report, how we put the valuation together, how we rate the intangible capitals. So you could just sort of judge yourself. I'll give that away for free to anybody. What I would like for you guys to do here in the audience is to please send me a message on Instagram. So if you follow me and you send me a message on Instagram at Vince Perri Official, then I will share that value clarity report. Value clarity roadmap is what it's called with you. It's absolutely free.
Very cool. And the report, that was the one I saw from the mutual client, which was actually very impressive. I
Mhm.
want to echo that again too. All right, cool. Vince, I can't thank you enough. Everyone that joined us, thank you so much. We're right here at the top of the hour. If nobody has any other questions, we'll let everyone get back to their day and go do something awesome. Thanks, everybody. Talk to you soon. Thanks again, Vince.